this is Dave Edwards, and today we're with Jill and Jessica over at the Paramount Residential Mortgage Group, and they've graciously offered to give us some advice and some things to think about as you guys think about moving up to Idaho. So, good afternoon, ladies.
Hi, how are you?
Hey, doing great. So, you're Jill. Tell us a little bit about what's going on today and what maybe these people should be considering.
Okay, great. What we thought we'd do is do a little bit of question and answer. So Jessica's going to kind of run through some of the questions that we get on a regular basis, and we thought that would help you guys with making some of those decisions along the way as you're trying to anticipate what will come up as you're making your move from California out to Idaho.
Very great. Jessica, what kind of things were you thinking of?
Well, usually the question that we get asked most is, can I move up there without having another job lined up, or how do we make that work?
Okay, that's a great question. So one of the things that we need to have is we need to be able to use projected income, which is perfectly fine. So what that entails is making sure that you can come out here, go ahead and do an interview process, have an employment letter in place, and that employment letter needs to include the title that you're going to be, your new job, the term of your new job, in terms of what your salary will be or what your hourly rate would be, what your start date will be, and it needs to be within a 30-day period of time that you're going to be closing on the loan, and then we can use that as projected income. There are certain times when we can actually extend it in an exception period to a term that is 60 days from closing, but that's highly unlikely in terms of an approval, but we can make it happen in some cases, but typically it's a 30-day window of time that we need to be able to do that.
Wow, there's a lot of details there. Are you guys, do you answer your phone if people have more in-depth questions?
Absolutely, and that's typically what we'd like to do, is be able to talk to you one-on-one. The one thing that we're very well aware of is that every single person is unique. So we're not going to look at your application and just take it for the numbers that are there. We want to know what your story is. Every single application, even though it might be the same loan in terms of a conventional or an FHA loan or a VA loan, every single person and their situation is unique. So we want to get down into the weeds with you and figure out what your unique situation is, because we're going to look at you as an individual.
Very nice. Jessica, what else did you have?
Usually, because our market is
it's kind of fast-paced. Is that kind of a good way to say it?
Exactly, yes. What kind of offer, when you go into looking at a home, what kind of offer is the most appealing to the sellers in this area?
That's a great question. So one of the things that we see a lot is that we know that you, as a brand new person coming into the state, you're probably going to be selling a home and then moving out here to purchase a new home. And a lot of times what you're trying to figure out is, do I sell first and then come out here and buy? Can I do it simultaneously? I know sometimes there's a little bit of a need to feel secure. Okay, I want to make sure I've got a place to live before I sell my house out in California. So there are a couple different ways that you can make that happen. One of the things that is really important when you're in a fast-moving market, like we want to call it here, meaning it's more of a seller's type of market. We have a very little inventory in this area, or multiple offers. It's very attractive for our sellers if you are able to come in with a non-contingent offer. So obviously you want to make sure that you go through this with your real estate agent and talk to them at length about that. But what that means is that your offer that you're putting in is not contingent on you selling your current home. And in some of the ways that you may be able to make that happen happen would be you can, let's say you have a lot of equity in your home out in California. So you may be able to use that equity now prior to actually selling your property. And the way to do that would be to actually pull a home equity line of credit on your current home and then use that as your down payment in order to purchase your home here in Idaho. Now, obviously, that's individual questions that have to go into that to make sure that you can actually qualify. But a couple keys in order to be able to do that would be a lot of banks or credit unions won't allow you to have a home equity line or issue that to you if your house is already listed. So you want to make sure that you're thinking about this ahead of time, and you want to be able to pull that equity line prior to listing your home in California. So that would be one thing. Another way that you can actually make that happen is that you may be able to take if let's say the offer on your home out in California, as soon as that is clear from all of the financial contingencies, we as the lender can then make sure that we remove that debt to income ratio restriction. And again, that's something we can get into a little bit more detail with you on a one-on-one kind of phone call. But what that means is we can actually remove that contingency right off of your offer, so that allows you to remove that extra layer of risk, if you will, so that we can finalize the actual transaction. So it does take that kind of that question to the seller out of the scenario, so that they know that you're going to be able to close on the purchase transaction without that contingency in place.
So from a real estate agent perspective, what I'm hearing you say is that if they still have a house to sell in California and they come up here and try to buy a house, then that might not look very attractive to the seller up here.
Correct. Exactly.
They might lose out on getting the house that they love.
Absolutely. So there are some ways so that we can help you make it more attractive. And that would be, like I said, is if you can carry both the payments, we can establish that with going through your finances with you. And that would be, you can either carry them, you may have other additional resources, whether it's assets from other accounts that you have. It could be your retirement accounts, it could be savings, different things like that. We can also show you how, once you've paid off your current home in California and you've purchased your home here, the proceeds from that California property, then you can, in certain types of products or loans, you can actually take those proceeds and do a principal reduction payment and then recast the loan. So there's a lot of different options that are available for you, again, which helps make the offer a lot more attractive to a seller here.
Jessica, what else? You have a long list.
Yeah. I sure do. I guess when you are looking to purchase a home, whether it's your first time, your fourth time, who is the best person to ask questions to make sure that you're making the right decision when you are going getting a mortgage or getting financial help with purchasing a home?
It's a really good question. A lot of times, because we all work as a team, between the loan officers, the real estate agents, and we develop great relationships between all of us. And sometimes it can be very easy, transaction coordinators, it can be very easy for you as the buyer to quickly reach out, and maybe you're asking a question of the transaction coordinator or the real estate agent or other people involved in the transaction. And the thought process might be, oh, this information is going to funnel back to the loan officer. But always remember that if it has anything to do with the actual loan itself, whether it's the earnest money, the amount of the down payment, as far as like your insurance in terms of like the cost, so anything that's going to actually relate to the structure, your employment situation, obviously purchasing the furniture, and whether you're doing that ahead or later, believe it or not, changing a job in the middle of getting a home while you're qualifying, purchasing a vehicle, all those different types of things that sometimes you're just doing automatically and not realizing that it could have a major impact. Those are things that you want to reserve, those types of questions that you want to reserve specifically for your loan officer. Run those things through them. Don't assume that we're all having a conversation about them, or that kind of information is going to get back to the loan officer through a different channel. Just come directly to your loan officer and make sure that we have that information, because you don't want it lost in translation.
So communication and questions are key.
Absolutely. They really are.
Did you have anything else that we could go over?
Yeah, will you tell us a little bit about how the state of Idaho works when you're married, or even if you're not, when it comes to closing on a home and title?
Sure. So we are one of a few states. I think there's 9 to 11. I would have to double check on that. I should know right offhand, but I don't. So, but we're a community property state. And what that means is that you cannot purchase a property in the state of Idaho without your spouse. The way I try and explain it to my clients, because it's like, wow, my spouse is not going to be on the loan, but they've got to sign. So they don't sign on the loan with you, but they have to sign acknowledging that you're purchasing a piece of property. So whether it's your primary residence, a second home, an investment property, basically you can't get away with buying something without them knowing about it. So just be prepared, because especially in a moving type of situation, and this is really critical, because if you have, one of you is moving here for work and one's staying behind, and you're packing up the house and taking care of all of that side of it, we still have to have both of you signing the same pieces of paper in order to close the transaction, even if only one of you and your income is being used to qualify for that loan. So it requires making sure that we're doing a mobile notary. It may require a couple extra days getting paperwork out to the other spouse, and then getting it back in. So it's really critical that up front, at the beginning of the transaction, that you're letting everybody know what the plan is going to be towards the end. Are you both going to be in the same location or not? And that way we can help coordinate how all of the closing is going to take place for you.
On the other hand, if there's a couple that aren't married, can they still use both of their incomes towards getting a house up here?
Absolutely, they sure can. They don't have to be married, and they can both be on the loan in order to qualify. There's a ton of different ways, which is a really good point. A lot of times people will think that they, in the case of, let's say, a parent, and a adult child. So we've had situations where parents want to help, their children get into a home and start, instead of renting, where they think that they need to purchase the home and then the child needs to rent from them. But a better way to do that is, if the child does have a good credit situation and income, is to have the adult child go on the loan, and then have the parent be a non-owner occupant co-borrower on the loan, because here in Idaho we have a homestead exemption, so that allows the property to go under that homestead exemption, which is basically if the house is over $200,000 value, it's $100,000, what I call a coupon. $100,000 coupon is what they get as off of the assessed value of the property, and then they're only taxed on the remaining $100,000.
That's huge.
It's a huge benefit.
Wow.
Yeah.
Excellent. Well, Jessica, did you have any more questions for Jill?
I don't think so. Just maybe whatever closing statements or closing information you want to give everyone.
I think the only other thing too would be to just keep in mind a couple quick points. Would be, obviously, moving from California to Idaho, property values there are much higher on average. So there's going to be some higher loan limits. So those can come into play. Moving, here our loan limit on our county loan limit is going to be $484,350 at the current time. This may be seen down the line, so you want to always check. So the point being is that California, because of the property values, may have a higher. So you're coming to a state which is probably going to have an average lower. So just check your yearly. Those change on a yearly basis. So check those on a yearly basis to see what the new county loan limits are, as well as just on a regional level. And this goes for anywhere you're going in the U.S. Regionally, interest rates can vary from region to region, state to state, obviously. Same thing, if you're in an area, you're living in an area where interest rates, the loan balances are higher, then on a competitive basis, the interest rates tend to be a little bit lower because there's more competition, because they have the ability based on margins to bring the interest rates down. And then if you're in an area where your loan balances are a little bit lower on average, then your interest rates may be lower. So typically on average right now, what you would see is from California to Idaho, you may see an 1/8 to 1/4% higher in interest rate versus what you'd be used to seeing in California. So just keep those kinds of things in mind so that you know kind of a little bit of a difference. And I think that's, a couple really good places to begin. The number one thing is always remember to ask questions. Reach out if we can help you in any way. We'd love to assist and be a good resource for you.
Great. It sounds like the answer is that it always just depends, and find your professional to get the right answers for right now.
I agree. I think because working with a team, a great real estate agent like Dave, working with a great team of loan officers, and that understand that each person is an individual. It's not a cookie cutter thing. There's a ton of different loan programs out there, and that typically there's a loan program for everybody.
Excellent. Well, thank you so much for your time today and for helping to maybe answer some questions from our audience or of our audience. Appreciate it so much. Thanks, and we'll see you guys around.
Thank you. Thanks for having us.